In this episode, we're going to talk about the potential overvaluation of the stock market at its current price, as well as going through two stocks in my portfolio that have dropped 10% this week, causing my portfolio to be down about 0.3%, £201. But doesn't matter because overall, the portfolio is sitting at 48,525 with a total return of £13,000 and a rate of return of 108.4%. To start off, I'd just like to show you the S&P 500 forward PE ratio. Now, as you can see, over a 30-40 year period, we are actually reaching one of the high points. Average being around 16 forward PE, we're sitting at around 22.3. This is obviously much higher than usual. I mean, if you look at the stock market's forward PE and compare it to the last time we had a major peak when stock prices were going crazy, which was 2021. After 2021, we obviously had a huge pullback in 2022 with inflation kicking in and bringing some sky-high valuations, insane valuations in 2021, right back down. You know, we saw crashes of above 90% for a lot of growth stocks. So it's just something to be wary of. Another thing that I'd like to highlight is that if we look at the Nasdaq's top 10, they actually make over 50%. And if we look at these, I'm looking at all of these here and I struggle to see a company in the Nasdaq's top 10 that isn't overvalued other than Amazon and Google, of which I both hold. Google, of course, is a stock that I'm buying into at the minute. I think that it's still undervalued. Amazon, I do believe, is also I think you'll be fine buying in at this price. I do believe that Google is more undervalued than Amazon, but still, it goes to show you that of 50% of the Nasdaq, out of 50% of the Nasdaq held by 10 companies, and most of it is overvalued in my opinion. Now moving on, we move on to one of the companies that dropped 10% after earnings came out, and it's in my portfolio. That company is ASML. ASML has been in my portfolio since late last year, and to be honest, it hasn't really moved much. My returns are actually negative 2%, but I'm up since where I purchased. It's just that my foreign exchange impact has severely affected my investment. I have about £3,500 in ASML. I'm just going to show you a short clip as to why the company dropped after earnings. Then we're going to go through the earnings and I'll show you my valuation using a DCF, discounted cash flow model calculator. So let's have a look and listen to this.
ASML warned it may not achieve growth next year. The Dutch tech giant said geopolitical uncertainty continued to cloud its prospects. Investors weren't enthused by Wednesday's update and shares fell 7.3%. They'd hoped the most recent quarter would provide some reassurance over its outlook for 2026. ASML boss Christophe Fouquet said the level of uncertainty is rising, citing tariffs as one factor.
Yeah, so essentially ASML said that their outlook on 2026, they cannot confirm growth yet. They said that they are preparing for growth, which in my eyes sounds like they expect growth. But obviously, the CEO wants to play it safe, and especially with Donald Trump changing tariffs all the time, he wants to make sure that he's not promising something he can't deliver, and that's my perspective on it. Obviously, others have taken that out slightly out of context and said, well, ASML cannot confirm 2026 growth. There's no growth in 2026 for ASML. I totally do not agree with that. I mean, unless Donald Trump does something absolutely radical with the tariffs, I doubt that will happen. If we have a quick look over ASML at the minute, it has a price to earnings ratio of about 27 after its latest earnings release on Wednesday. If we have a look at what it's done with its revenue, trailing 12 months, year over year, we're looking at 26.41% increase in revenue. I mean, this is pretty explosive growth, if you ask me. Here's another reason that the stock may have dropped. If we have a look quickly at the drop that I'm talking about over the 1 month, you can see it fell quite a large amount. Another reason that the stock may have dropped is the net bookings fell year over year slightly. The net bookings fell slightly. That's just the amount of machines that they are booked to deliver. If you don't know what ASML does, you should look them up. They are a great company, but essentially they just create EUV machines, which are the foundations for making chips. So they make the machines that make / etch the silicon chips, and they have a complete monopoly in that area. If we have a look at ASML's revenue by segment, you can see that the memory chip development side of things has gone up year over year, and the logic has also gone up year over year. Obviously not as high as its Q4 2023 peak, but it's getting there. Not only that, but you will see an install base management start to kick up as well. So as they install more machines, ASML have to service more machines. So as they've given out more machines, there's more service, and they're bringing in more. So you can see in 1 year that's gone up 33%, that revenue from the install base. Another great bit of news in terms of ASML is that it is starting to kick back up its common stock repurchases, so its share buybacks. And this is good because it's going to return a lot of capital to the shareholder. It's going to decrease the amount of shares outstanding, which will then increase our share in the company overall as a percentage. This in turn obviously kicks the stock price up. Now, if we have a look at ASML's valuation over the past 10 years, its average price to earnings is about 35. I think it's about 30. Yeah, average over the 10 years is 35 PE ratio. So if we have a look at this, PE now is at 27, much lower than it previously was. And you can see it, it's had huge peaks, and we're kind of at the low end now. Really, we don't see ASML at these kind of prices very often. Now, I do also want to highlight about ASML that it is a cyclical company, and only one of the 3 foundries is buying its latest machines, which is the high NA EUV machines, and that is Intel. So Intel has been buying most of ASML's expensive high-end new machines, and this leaves TSMC to still start purchasing them. So we're still going to see runway with their high NA EUV machines from TSMC. Intel's done quite a lot of purchasing. They might slow down a bit. TSMC might kick up. Samsung might kick up as well, considering that these 2 companies haven't fully committed to the high NA EUV machines, and it's only a matter of time. So moving on to the valuation analysis on ASML. I've created a very standard 5-year projection for ASML, and that is that the EPS, so the earnings per share, will grow at a rate of 13% annually from here on out, and that their EPS multiple, so their price to earnings ratio, is 30, so actually higher than it is at the minute. As I've shown you, their historic average is about 35. Right now they sit at about 27, so I kind of picked just below midpoint and went for 30, and this offers you from here a 15.5% return, which is obviously what we want to see. I explained in a video that if you continue 15% returns for 5 years, then you double your stock value, and that's exactly what happens here with a projected price of $1,540,000. The company currently sitting at $748. An entry price for a 15% return in this scenario is $765.88. Now, moving on, the other stock to drop 10% in my portfolio was FICO. FICO is another stock that I own in my portfolio, albeit a very small amount. They have dropped quite a lot over the past, since the beginning of the year to date, we're looking at negative 22%. Literally over a month, we're down 12%. Now, FICO did drop because Polte updated the credit score policy for mortgages, and that's what has hit FICO today. And basically, he has changed it so that the Vantage score can be used as well as the FICO score for mortgages, and this has meant that FICO doesn't have a complete domination over mortgage lenders. They have to use their score, and that meant that their pricing power is slightly decreased because of that. However, FICO is totally embedded into the ecosystem to the point where Capital One did change to Vantage Score and has now changed back to FICO Score despite all of the price raises from FICO. This is why I do not see this as much of a threat to their monopoly, especially as Vantage Score is not what the industry is used to at all. They prefer using FICO Score, as you can see by the swap back here, and just general consensus. In my opinion, FICO will probably hold off from raising the prices on their scores for a little while to draw a little less attention, and also because there is now competition to fight against. Although I do not think the competition is much of an issue. However, FICO was overvalued at the time. It still trades at 65 PE even after its drop from 2K at the beginning of the year down to about $1,540 now. Now, FICO obviously fundamentally is a beast, with revenue going up about 15% yearly, and the free cash flow is just incredible. I mean, what year over year, free cash flow has gone up 60%. I mean, that's just crazy, honestly crazy. So, you could probably see if it continued at this rate, which I don't think it will. Like I said, I think it will slow down slightly because I think that FICO do not want to draw as much attention as they previously did with their price raises on the FICO score, the credit score they offer. Even with a slowdown, you're still going to get a really fast growth rate. To me, it's just the multiples that are way out of whack. They're just too high. You could probably justify them if the free cash flow continued to grow at a rate like this. I mean, you could definitely justify it if free cash flow grew at a rate like that. But over the 10-year, it's grown at about 23%, 23.5% in terms of free cash flow per share. It is a really high quality company, and I do not think that their moat has been hit slightly, but not very much. They just need to be a little bit more careful on the price raises, which probably means that the free cash flow will slow down a little bit. So looking at their valuation, I input a few things. Obviously, over the 10-year, we saw 23%. So I've lowered that to about 17% and said that expected annual growth rate of free cash flow is a 17% growth rate yearly. And then for the free cash flow yield, which is currently sat at 1.84%, I have said that it will increase to 2.5%. I mean, if it was to stay the same, we'd get a better result. But this gives us a return from today's price of about 10%. So, in line with average market returns. I wouldn't say it's a buy at this price. I'm glad that when I bought in, I got excited on the dip. And I'm glad that when I bought in, let's have a look here. I bought in after this dip when Bill Pulte first made an announcement about FICO in a tweet. And I thought, nothing's going to happen. He then mentioned them again, and the price started to bounce back up to my initial buy price. I thought, right, Bill Pulte is going to say something again. It's going to drop again. So I sold out and moved my money into various other stocks, including Google, MasterCard, Amazon, and I believe Texas Roadhouse. And I am glad that I did that. I left a very small portion, about £60 in there, just to see what would happen. And yeah, it's dropped a lot. I don't think I'm going to buy it anymore at this price, not until it probably hits around $1,237 here for that 15% return. Very high quality company though. I don't blame you if you do invest on this major dip here. I just don't have faith that they're going to be able to raise prices just as quickly as they were before. We'll see how this one turns out. At the minute, I'm happy with the portfolio. I don't think I'm going to be buying any more at the minute. Google's price is running up since I started buying it, which is great to see. I will hold off until I get some more money because I am out of funds at the minute. See you in the next one. Bye-bye.
I'm hopping out Ferrari. My house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring. For real, I was snoring. The VP was fine, yeah, she treated me kinda corny. But that's another